Good evening, everyone. Dear members of IPMMA, welcome to the webinar on different avenues of raising working capital in the digital age. I, Kinjal Desai, the head of alliances and partnerships at BillMart, is your host for today. The audio and video of all attendees are muted, although they can share their thoughts and queries in the chat box as and when required. There's also provision for question and answer in our today's event. A request to please drop your questions, if any, and we will address them as and when the time permits. The agenda for today's webinar is to address the need of the hour and to give you a spectrum of choices from avenues of borrowing to the avenues of investments. For a nation's economy to touch the US dollar 5 trillion dream that we have, lending on a big scale is the need of the hour to ensure that the MSMEs, which are the backbone of Indian economy, can flourish and grow. There are roughly 6.5 crore MSMEs that contribute significantly to our country's productivity and employment. Despite its significance and reach, the lack of credit has slowed down the sector's growth. I would like to start the session by quoting our IT Minister, Mr. Ashwini Vaishnaw, who stressed the need to create an innovative digital platform as powerful and seamless and as robust as a UPI for providing quick and easy credit to MSMEs, small businesses, and those at the very bottom of the pyramid. This combination of technology and understanding of the on-ground challenges has the capability to create a more approachable and a complete credit cycle model for MSMEs, which will eventually have a tremendous effect on the growth of the entire ecosystem, which is exactly the space we are in today, and we will familiarize the same with all of you. Without taking much of your time, I would like to introduce you to our speakers today. Our first speaker, Mr. Oswin D'Souza, who has an illustrious background where he was instrumental in making the banks reach closer to our home through the ATM drive. Oswin has been at the forefront in installing ATMs across India for banks like SBI, ICICI, HDFC, Axis, and many more. He was also instrumental in beginning the multilingual project on ATMs. Oswin is running his family legacy business at Oswald Scientific Equipments Private Limited, where he's the director. Currently, he's the secretary at IPMMA and working on the Skill Academia project for IPMMA. He's also the executive committee member in FICCI Maharashtra State Council MSME division. He is an electronic engineer from St. Xavier's and business management from NMIMS Mumbai. It's a pleasure to have you with us, Oswin, today. Oswin's note will be followed by a presentation by the Chief Business Officer of BillMart, Ms. Jyoti Rai, who will be covering the role of FinTech in bridging the lending gap. Jyoti's presentation will be followed by an enriching moderation with our guest speaker, Ms. Sucheta Shah, who will speak on alternative avenues of investment. With an experience of close to 3 decades, Sucheta wears several hats and is literally the kind of professional we say she's been there, done that. Currently, the promoter director of Atlas Integrated Finance Limited, which is a wealth management and financial service firm. She's an independent woman director on several boards, to name a few: Tata Housing Development, the Indian Human Pipe, Jayant Agro Oils, and many more. She was the chairperson of the Maharashtra State FICCI MSME sector from 2018 to 20, and she's been an active member of FICCI Ladies Organization since 2003. She was also the chairperson of the Flow Mumbai chapter for the year 2011-12, where she launched the project Swayam, a support cell for women entrepreneurs, and took it to national level. Thank you so much, Sucheta ma'am, for agreeing to be a part of this event. We will conclude the event with question and answer session if there is no time constraint. But before that, there will be a special vote of thanks by Mr. Samir Limai, a veteran who comes with 3 decades of industry experience. His accolades, to name a few, are: currently he's the director at Venco, director at IPMMA, immediate past president of IPMMA, and an active managing committee member at IPMMA. He is a mechanical and production engineer from Yashwantrao Chauhan College of Engineering in Nagpur, and he's done his MBA from IMI Delhi. It's a privilege to have you, sir. Once again, I welcome you all, and now I call upon Mr. Oswin for his keynote. All yours, Oswin.
Thank you, Mr. Kinjal Desai. You've been wonderful. The introduction given is so nice. It really made me feel awesome. Yes, also felt a little bit nostalgic with the ATM industry. Back then, it was very nascent and just at the beginning of it. And I must say, I had an enjoyable time at that time. Although the software at that time was very limited, we were working on OS2 platforms. And yes, I had the privilege and honor to install the first ATMs of State Bank of India, ICICI Bank, HDFC Bank. It was a great honor to do all these things at a very young age. So thank you, Kinjal, for this. Moving on to the subject in hand and the topic in hand on this webinar on avenues for raising working capitals and alternative modes of investments. These are two topics which is a very crucial topic for most MSMEs and especially us IPMMA members, where we face our biggest concern is on these two areas which we face actually. Being in the industry for so many years, having my own business, I know how it feels when we literally face problems in these two sectors, these two areas. On a personal level, I could give an example of my own company. Like for example, most of the MSMEs, IPMMA members, we are all first generation or second generation entrepreneurs. So here is where we literally, most of us have been at the shop floor, you could say that, especially our parents who have started the business. So currently, I would say, if I have to give you a brief background on IPMMA members who are here in this webinar, most of them are first generation or second generation. And if I speak a little bit on the first generation entrepreneurs, they are the ones who have literally started from scratch. Like for example, my dad, who came from a village in Bangalore, small village in Bangalore, and he comes here at the age of 16, works as a house help, and takes up a job as in when he's a little older. And from a job, he starts his own company, literally with nothing in hand, no working capital, nothing, just starts off a company and gradually grows his business. Takes him years of efforts, and literally he works on the shop floor, he runs around, he does everything himself. And thereafter the business grows. And then we come into the picture, the second generation, with a little bit of education. Like most of us are engineers, and most of us have done business management, and here we take on the second legacy part of it. So, but the areas that we see, the concerns that we see has always been the same: working capital and how to invest your profits. So this has been an area of concern I have felt has been there for the last many decades. And therefore I was happy when I spoke to Sucheta ji that I need to address this concern in IPMMA. And I was glad that she actually put me on to Ms. Jyoti from BillMart, and together we got this webinar going. That was wonderful. And I'm glad that we all are here. And I would rather say addressing the working capital issue is where our concern is mainly cash flow and how to address large orders. And I think that is where we are helping us on it. The problems that we face is on banks, where banks are able to give us working capital loan with collateral security, which creates a problem for us at times. Even when we need to expand ourselves, we face the problem of limited tenure term that we get of only 5 years. So the principal and the interest amount works out so high on the EMI that it gets difficult for us to expand in the manner in which we want to. If we compare ourselves to China, the manufacturers are having huge plots of land where land is not an issue. The government itself is giving us, whereas out here we are having a little difficulty with land itself. So in China, when we compete with countries like China, the problem we face is first and foremost land, buying the land and repaying this piece of land in a span of 5 years. Then the issue comes of machinery. Again, same problem, 5 years. So it gets very difficult to actually expand ourselves. So this is the area of concern which we always feel has been a kind of a reason why, to a certain extent, we have been stunted that we couldn't grow as much as we should have. So I'm happy that this issue is being addressed today. The second part of the webinar, where we are talking about how to invest profits, that is also a very important thing, because most of us being engineers or shop floor people, we do not know at times where to invest. So we are afraid of PMS, we are afraid of share market, we are afraid of, and FDs are anyway giving us very low results nowadays. So it's pointless. So we need some kind of an education level where we can move forward with these investments. So I'm glad that these two major concerns are being addressed today, and I hope that the members who are watching this webinar will be enlightened today and will be more confident after this webinar to go in for predominantly remove their fears of digitization which has come about. And in a way, this webinar is something which I'm greatly looking forward to myself. Thank you. Kinjal, over to you.
Thank you, Austin. I'm sure there would be plenty of takeaways from this webinar. So as we move on to our next speaker, Jyoti, who will be covering the role of fintech in bridging the lending gap, and will also show you some glimpse of the system. BillMart has recognized the pain points of MSMEs regarding shortfall of working capital and how fintech firms can bring MSMEs of India closer to credit and bridging the funding gap. To share the role of fintech in digital lending, the CBO of BillMart, Jyoti Rai, will take us through the same. Over to you, Jyoti.
Thank you, Kinjal. Lovely. Yes, your anecdotes about the MSME size and scale and their requirements have been very, very played out very, very clearly. Most importantly, what was also very not just nostalgic but very overwhelming was keynote of Oswin, where I think today we are completing a journey where he led the ATM physical installation revolution to today supporting us on discussing the digitization and how we can use digital medium of getting our working capital sorted. So it's been a wonderful journey out there that you have covered, and thank you for this opportunity to the team BillMart. And I completely agree with you that this curated webinar actually takes care of more than just digital introduction for the MSMEs or your members. It also takes care of the other side of the spectrum. What if we are cash surplus? And what do we do with the investments? Where do we go? So I think Sucheta is just the right person to kind of give a very comprehensive view. But I'll just set the ball rolling with regards to my topic of presentation today, which is, just give me some time. Is my slide visible?
Yeah, it is.
Yes.
All right, lovely, great. Sorry. Okay, so to all the members of IPMMA who are listening to us today, I am going to be covering very, in a very lighter way, the role of fintech in digital lending, and what is fintech actually doing in this space of removing pain points. So it won't be very ambitious to say that what Google Maps or GPS is to navigators, BillMart intention is to be the same, a marketplace for MSMEs navigating their way to working capital. You know, there is always a piece of a technology we get highly dependent on, and we don't even realize how important and integral it has become in our lives. I am hinting towards the same. As per the RBI source of data, credit demand by the MSMEs in India stats at a wobbling $490 billion, out of which $190 odd are only met by the formal sources. The formal sources typically, as we know, are the family, friends, banks, and conventional way of writing your application and doing things like that. The biggest concern, which has been acknowledged today, and Government of India, along with other policymakers, has been working tirelessly to identify that how can this gap of 330 billion be bridged by service providers. And the one tool that stands out, which was also mentioned in Kinjal's in his introduction, that how it is almost done and expected that the digitization and the fintech revolution will be here to address the gap. And it won't be too much or a tall statement to say that the digital adoption by the businesses will be a tool for them to pivot from here to the next. Speaking of gaps, we have to identify them, then we have to balance the scales, and then of course look at ways of bridging these gaps and pitfalls. So this slide is a very interesting one. The most simplest way to put across would be on the Libra that you see in front, there is 12 to 36% interest rate. What it typically says that there is always someone, a business out there, who is ready to discount his bill or raise working capital in the range which is so high and broad. On the other side of the balance, there is someone out there who is ready to deploy money in a much lower bracket. But the MSMEs or the corporates sometimes do not get access to this, and which is where we thought that the BillMart is going to do exactly, at least balance the scale. And the balance of scale can happen by awareness, by letting people know that there is a world of finances out there which are looking for certain parameterized MSMEs, and if they fulfill that, you are out there on the platform. So we are focusing on a very important opportunity of shifting the power from finances to business. What it means is that making businesses aware of what are the options available to them. And while we balance the scale as we move ahead, we have also made assessment that what does the great credit divide looks like, where it's come from, what are the various risk assessment models that are used by financiers collectively. So if we have to see it and slice and dice through it, it's a 3 C's approach which majority of the financiers take. One is building your risk assessment based on your capital. All the capital, the assets, the collateral, the hard land, the soft assets are clubbed here. And as Oswin mentioned in his keynotes, that collaterals are not always easy or available. And in case of MSME especially, they're already almost all the time leveraged. So, so we move from capital to character. If there is less of capital, what do? Of course, there is a huge track record or a payment track record or data sets that are available to build up a character of the firm. It can start well with the proprietor. Is he paying bills on time? Is he paying his employee salaries on time? So who is putting this track record together? Okay. The last C of the credit profiling is the capacity. So in the capacity, what is assessed is whether the cash flow generated by the businesses, whether current or future, holds any ability to meet the financial obligation. So that there is an assessment that keeps happening around these 3 C's, and where where the fintech or BillMart steps in is both on character as well as capacity, because we are talking about unsecured loans on this platform. Now, this is to also understand from the MSME that what does how does credit lines are given which are beyond collaterals. There's a very common question that comes, that what is actually happening behind the scene. So this is a very educational slide to mention that what are fintech doing? Fintech is today moving from a human-based screening to data screening. Okay, we are collating all the data which makes your character of the firm of the entity become more robust. So just to give you an example, in the human or a traditional screening, your collaterals are one of the widgets to assess. There are certain specific documentation, certain credit history or a credit score that is required. In the fintech screening, lending is empowered by data analytics. Okay, which is what in my subsequent slides you will see that how fintech really helps you change the game and gets you closer to your working capital requirements. It is also becomes a very important activity. In fact, the most important activity is to analyze and assess borrowers, not just their needs, but also their repayment abilities. Having said that, this helps the financiers tackle their credit assessments very well. And in fact, it also helps us get credit to the MSMEs which are neglected because they are not supposedly in their credit worthy from the capital or collaterals point of view. So this is what fintech does. This is what a platform like BillMart does. Now we are also plugging ourselves into a very important stack of data repository and API frameworks, where the huge support and thrust has been there from the government of India. And there has been some amazing digital initiatives already in place, like eNACH, there is UPI, eKYC, digital signatures, GST data is made online. It's highly end-to-end data is out there available. MCA website, any other IT integration today, all of this together has become a very important springboard for the, as we say, for the proliferation of the digital lending. Now, so who we are when we are doing all of this, taking care of a credit assessment, analyzing everything around you, and making you, what you call capital ready to receive borrowing ready. So we are a fintech platform that is enabling digital lending to the MSMEs and corporates, which is supported by machine and human intelligence, backed by big data and analytics, robust and scalable technologies for seamless and cost-efficient end-to-end digital transaction. Now, what would this really translate to is something that I'm going to be showing. Now, this is a quick slide on majority of the platforms, majority of places that we have spoken, the MSMEs, and the maximum requirement which is coming on our platform has been bill discounting. So I'm just going to take you through a very simple bill discounting process, which majority would know that you submit bill, the approval of bill and obligation by the counterparty takes place. There is bidding by the various financiers. Bid is accepted. Then once the bid is accepted, after analysis and best bid criteria shared between the financiers and MSME, funds are distributed, and in less than 24 hours, accounts are crossed and settlements happen on maturity. So very simple process of bill discounting, which is the highest deprived of working capital in terms of product by MSMEs, is getting discounted on our platform. I will give you a quick glance of how does this platform becomes the window to unlock your working capital, and how is this happening through a digital interface is something that I will I'll share some quick snapshots of. So welcome to the key screen when a business has to log in. There is an easy sign up login screen. You use your mobile number and you get cracking. Once you come after you have registered, you will be prompted for classify your MSME or type of organization. The moment you select your classification, whether it's company, LLP, partnership, or proprietorship, the ask of documentations in the subsequent slides would change. So this helps us in categorization straight away. Basic business detail that are captured are, of course, they're in front of your screen. We pick up from MCA, GST, and business name. Bank details are fetched from the API integration that I mentioned to you. We have it with several banks. MSME corporates then gets a single window to upload the necessary requisite or important documents in one go. So you don't have to flip and flop between different screens. You have a screen, you start uploading the supported formats. Income tax returns, details, your PAN number is required for registrations. Once you do it, you move on, and your GST details makes everything else very handy, because your character, as I spoke, which is a key part of non-collateralized lending, comes also from your data sets like income tax, GST, and other important registration numbers that you have for your business. Once the registration is done using the key data points, then we move into the service agreement, which is made digitally available. You can sign and upload, you can sign digitally, upload the copy, and move to the next. The NACH mandate screen is pretty easy, convenient. You upload your mandate, and where does it get reflected? I will also share. Imagine this, in fact, this was a cup of coffee, data which was added in the system. This is a dummy. So the data that we collected in the beginning from the MSME that is registering here gets analyzed and stacked on this red box. As you can see, it's populated in different tabs, because that's how a financer will also find it convenient to have your information completely in one go, in one slide, and they can move between various tabs to get your data and analyze you online. Just a minute. So when imagine this is the day when Kappa Coffee wants to do its first bill discounting. This is the main screen that the business would see. It's a very multi-view screen that has been created, that the dashboard gives you at a glance bills. Currently there is none. We're going to start discounting now. On the right hand side, there is a message box. So that is where the AI and works at the back end to curate messages and alerts for the user of the platform. Nash mandate at the below bottom gets updated, and a lot of information touch points are made available in the first screen itself. If we are initiating a bill for discounting, once that tab is clicked, the initiate for bill discounting screen comes up. Self-explanatory, simple, watered down screen where your counterparty registration is gets populated. Your counterparty seems like Reliance Industry, and now you're uploading your invoice for discounting. This is what the Reliance Industry, the buyer, would see at their end, that there is a bill that has been uploaded by a seller and it requires approval. So the moment the buyer approves the pending bill, it comes back into the dashboard of Kappa Coffee. This is the dashboard of the business, Kappa Coffee, where this dashboard has multiple data points which are crunched and presented. The bill which has been approved by the business, in this case Reliance, is seeing various bid in front of you, 11, 11.25 and 7, So once this dashboard gets populated, then you know that you have received 7 bids, your payout is scheduled on certain day, and what are your payment amounts. That the platform analyzes and does all the computation and brings you a clean dashboard for your overview. Once the pending bill is done, is matched, or it's picked, it's discounted, the final closure deal ticket, a transaction book throws up the deal in front of the MSME. So again, a very simple navigation and very easy to read, analyze data points thrown in front of you in a very structured way, and which makes the whole experience very, very convenient. It's a very important slide here, that once you have finished your bill discounting and you want to now go to your fund settlement window, you want to just see what's completed in all the bills that I've paid up, which are the pendings, which are the upcoming, one dashboard that gives you a comprehensive view of the same. Now, the color coordination is very logical, that pinks are the pending, yellows are the upcoming one, and the completed. So even through a glance of over the color combination, you would know statistics, were just popping up in front of you. So a very intuitive system again, which has been built up, very waterlight, very ease of navigation, as I said, so to say. So this is a quick snapshot of our system, and those MSMEs who are looking at getting more insights can always get in touch with the team. It's a very it's a must-to-have slide. What are the advantages which members are gonna receive? Of course, till 2023, we have 0 registration charges, we have 0 transaction charges, we have competitive interest rates, we have real-time bidding by multiple financiers that MSME gets to access. And of course, we have a very simple but yet state-of-art technology that seamlessly integrates with your billing and accounting system. So these are a few of the advantages that we picked up. There are quite many of them, but this is something that would definitely stand out for now. A Of course, for us, the way we see at BillMart, for us, the business is the king, and unlocking working capital is absolutely necessary. And we will do our best as a fintech firm to unlock the working capital with as ease as possible. We support channel partners, which has the required stocks and credit for unlocking their funds. So we are looking at channel financing as well. Needless to say, it's an end-to-end digital process. We aim to make MSME more capable, or businesses more robust, to have a better vendor management, faster payment cycle. I hope that it helps you reduce the cost at multiple levels and save time. And this is how we see at BillMart that while we are focused on India, but trust me, we have the potential for building absolutely universal infrastructure for digital lending. And of course, out here to kind of help support MSMEs and members of IPMMA and associations to get as much as clarity on using digital tools to get ready for working capital in the unsecured lending space. So this is from my side, and I'm happy to take next clue from Kinjal and bring on board our guest speaker. Hey, Kinjal. Yes.
Thank you, Jyoti. Thank you for your time. Now, I would like to welcome Ms. Sucheta Shah, who will dive deep into the details of what are the different alternative modes of investments and how can you increase your profit margin. Over to you, ma'am.
Yeah, sure. In fact, lovely to have you, Sucheta, today amongst us. I have seen you in your avatar of MS, when you were there in the FICCI flow. And Kinjal spoke about Swayam initiative, and that's very nostalgic for me because I had a opportunity to kind of work on a smaller scale. But what's superb and enterprising is, Sucheta, that you were leading it then and you're not given up even now. So whether women entrepreneurs or not, I'm sure that's always the case, but you have never given up adding value to this sector of MSMEs through your experience and intellect. So wonderful to have you. And in fact, I have a few questions already that has come in to talk to you. So if you allow me, I can just open up because Oshwin mentioned something very interesting, that how this webinar is taking care of the members' requirement on the MSMEs that are looking at direction on investments, which are surplus in cash. And Oshwin is on the video. I'm sure, Oshwin, would you like to add something here? Any specific question?
Go ahead.
Okay, all right, lovely. So Sucheta, without taking much time, of course, would understand from you that what are the, first of all, to familiarize with different assets that are available for investments. And of course, we'll deep dive as we go forward. So yeah.
So when you invest, it is vital for you to know where your money goes, to which asset class, and classification of asset has certainly made finance more manageable for the investors to comprehend. Risk factors, taxation, return rates, liquidity, tenures, and market volatility differ according to asset classes. Hence, investors often rely on asset diversification to earn maximum returns with minimal cost. So I would like to share my screen here. Most of you know what these assets are, but let me just touch on them a little. The cash and cash equivalents, these are known as money market instruments. It is not confined to cash, but also idle money in your savings account or any other liquid schemes. Nothing gives more transactional freedom than cash. However, it cannot beat inflation, and the returns are too negligible. Coming to equity, it's an ownership into business, means buying into business where you buy shares of a firm or you have a percentage of ownership. The only hitch here is that it comes with a certain amount of risk. Any business times have taken time to grow, and are subject to internal and external risks and fluctuations. So there are market fluctuations, and this impacts the share price. Coming to fixed income, when you're lending money to somebody, of course, the oldest forms are the fixed deposits and the PPFs, but let me tell you that they're all subject to short-term and long-term capital gain. So it is not only that the interest income which is taxable, but when you sell that or when you redeem it, that you have to applicable, even a capital gains tax is applicable. And short-term here is less than 3 years, beyond 3 years. So long-term is indexation based. So fixed income schemes can offer only security, but no wealth growth. Again, debt funds, which are NAV based mutual funds, can also give negative returns in case of a rising interest scenario. Anyways, one more new short-term avenue for corporates would be joining the fintech platform, such as BillMart, as lenders or as financiers. You could discount bills of some AAA rated companies for a shorter period and maybe get a little higher interest rate income from, other than fixed income or cash. So Jyoti, this is for you.
Thank you.
And then coming to real estate, that is ownership of the physical space, such as plots, apartments, commercial buildings, industrial areas. The property market can be a little unpredictable. But now with RERA coming in, it is becoming a little more structured and monitored. However, it is advisable to buy REITs, that is real estate investment trusts, if you only want to do it for investment purpose, because they can be liquidated and they also enjoy the indexation benefits of a capital gain, which can be available for long term. So you should buy property only, actual real estate only if you really require it. This is a suggestion, of course. Commodities. That is commodities, that is ownership which has an end use. It can be anything ranging from goods, properties, products, which can be traded for different purposes. Examples are gold, silver, food, crops, petroleum. These are some of the commodities. They are mainly cyclical in nature and fluctuate based on their demands. Beyond this, there are a few alternative investments. And this would be a unique investment, which is not traditional. Examples, the artwork, which can give huge returns, but highly illiquid. Cryptocurrency, the latest on the board, has high risk, high returns, but not structured. So we stick to these assets which we are already there and their performance.
Perfect. No, thank you, Sucheta, for laying out the options all out. You covered the entire asset classes in the shortest period of time I've ever known. We spoke about risk and we spoke about hint of performance. So when it comes to asset classes, we cannot not speak about performance over a period of time and keeping the risk matrix and stuff in mind. Could you please take the members, our listeners today from there? What is the return and performance expectations of these asset classes?
Yes. So this, if you can get, this is the asset performance and the percentage returns of various assets and their subclasses over the last 10 years. If you can get to see, but I'm just planning to take the major groups. So assume, let's take the equity. We have the large cap, the mid cap, and the small cap. So we have this various subclasses too. So what do we see? That in 2012, equities performed very well, and then suddenly they go down, and then large caps and all in 2015, 16, they are, giving, in fact, almost giving very minimal returns, and it's given 2018, the small caps have given even negative returns. Then what do we see? That again in 2020, 21, they give fantastic 30.75 and 58.96 returns. So what do we see? That the risk factor and the volatility increase from large caps to mid caps to small caps, but the returns also are better. So of course, this requires a lot of research, a lot of going into, but they're already seeing. But what we can see is that once they are at the top there, in 2022, we're already seeing the small caps and the mid caps underperforming comparatively. So it's very important that you keep changing your assets, your asset allocation. Now coming to debt. So we have the T-bills, which are the easiest, the corporate bonds, the G-Secs. So they have almost been giving steady returns, but the performance is comparison up. I mean, that goes up and down. So, but what we see here is that G-Secs have been, the debt has been reducing because of inflation, or they're too dependent on the interest rates and the inflation cost. So that would be, now real estate, in fact, if you see overall on the picture, you see that it has been an underperformer for many, many years. So we expect that it should rise once it's more regulated. Gold returns also have been very volatile because you see it is dependent on many factors such as the US dollar, the demand, and even external work like the war, which is going on right now, has taken gold to what, I mean, it was minus negative return in 2021 and it has shot up so much. For gold, I need to just add one or two more points is that, you must know, we see gold rising so much, but from 1985 to 2005, it was almost flat. And so it's not that, just because, always remember that past performance, not necessarily, which is always a risk factor in the mutual fund investment also, not necessarily the actual, what will show the coming performance. Another research which has been on gold and BSE Sensexes, both were 4,000 in 1999. Both were at 4,000. And both touched 50,000 in 2021. So, but what has happened is they've not performed together. There are some periods where equity performs, some periods where gold performs. So we have to, so what is the key takeaway here? Is to have a proper asset mix and to change the asset allocation from time to time on a constant basis to maximize returns. This would be, where, I mean, and this is better when you will understand this more even when you take it sector-wise.
Fair, Sucheta. No, thank you so much. I think this is a very important slide. Initially I had a feeling of snakes and ladder, as Sucheta is going to show us a snakes and ladder game.
I will do that once we come to the...
Okay.
Yeah.
No, but this is very interesting, Sucheta. Just to summarize what the understanding should be from here, that there are sectors and there are returns linked to these sectors. However, over the period of
this
time,
is the asset.
Assets, yeah.
These are assets, yeah.
Asset classes and the return associated with them over a period of time. This is the performance of each one of them. And one thing that truly stands out is that, what was a flavor in 2012 may not be the flavor in 2022. So what one do is to manage the things dynamically and do a correct assessment of your sectors and based on your performance, risk appetite and everything. Now, there is, when we talk about, since we are talking about equity investments and, as one of the asset classes, there is always a mention of value investments as well as growth investment. Could you just share a quick brief on for the listeners?
So let me go to the asset, the sector performance matrix also, right? So, taking equity, because equity is where you can really get the returns, because fixed income is not. So here we get, so this is where, if you see, again, it's similar, that banks were very, with the best performers in 2012, in 2020 and 21, they have been the most, the absolute underperformers. So there are reasons for it, of course. Similarly, IT was absolutely low in 2012 and now it's at the top. So what is it? So now let me come to the value investing. So here what we see is somewhere what is at the lower level. Now in 2021, we see that autos and banks are at the bottom. But this, if you invest, it may not be that just in 1 year they may perform. But when they are at the bottom, your downside is minimum if you invest into them. And if you take an SIP for next 1 or 2 years, 3 years, there is a big chance that you will get a very good return. So in equity, you need to have patience. So that would be where your downside is minimized, would be a value investing. Say, for example, here earlier in 2013, PSU was at its bottom. Then slowly, it has been coming up over the years. But maybe if you had done a SIP for 2-3 years, right now it is at quite high. Now, so growth. In fact, pharma in 2016-17 was at its bottom, and with the pandemic coming, it almost performed the best in 2019, and most of the pharma companies have become extremely cash surplus because of that. So that is your value investing, that you buy something which is at the bottom of the matrix, and over a period of time do an SIP and you will get a good return. Now growth would be something like, say, in 2019, if you can see the IT, with the pandemic coming, the growth was exponential. So somewhere in middle of this performance matrix, if you invest, so we believe that 2021, the growth would come from your MNCs, from your PSUs and the infra, which are yet to, which have come up from the bottom, but yet to show their growth. So you can invest into these, which would give you, at a shorter period, maybe value investing can take time, but you're certain and your downside is minimum. Growth investing can take time, but the returns can be phenomenal within a shorter period of time, within 1 year or 2 years, and that may take 3-4 years. So that is it. But here, that is where now your snakes and ladders is what I would like to say. That, we were all playing that game, and, always the top 2 columns or the top 2 rows would have the highest number of snakes. And then, you can just come down to the bottom. So here, what we would suggest is something which is at the top. Maybe you should reduce your exposure to a certain extent rather than coming right at the bottom. So, and start increasing. That's something, that is where the asset allocation and the mix comes. That you start adding which has value and reducing which is overexposure. So one thing I would like to tell you, that at any point of time, there is something which is undervalued. So whatever the market is, whether high, low, there is always some option available, some asset available for investment, and some sector available for investment. So it is just that you need to do a proper, it sounds easy, but a lot of fundamental and technical research also goes into them. And then there are a lot of headwinds associated with them also,
Sure. Of course, no, we would need to have an understanding of which are the headwinds and the risks that are associated with most of these investments before we move into the passive side of investments and, cover as much as possible in this. So if you can quickly take us through the risks that one needs to be aware of and various headwinds that operate around these asset classes.
Fine. Yeah. So which are the types of risks? So these are the asset classes which you normally would invest into: equity, commodity, debt, sector. So what are the risks associated? One is the company inherent risk. So, which is inherent to the company. So business risk, for example, PVR and Inox. They went bust. They were of no use in the pandemic. So you couldn't even go, and they were completely. Financial risk would be like Jet Airways, Reliance, where the debt went beyond, and they could not, actually the debt equity ratio was absolutely beyond, and they couldn't service it. Operational is sometimes they're not on a large scale, but they're small. For example, HDFC Bank. The markets went down because of their credit card. There was some operational risk. It was not that there was a management failure, but it was just an operational risk, which compliance, of course, Satyam is a big example for that. Then there is national risk. This is, of course, not into our control. That is the political risk. Change in government, where you have the Argentina example, the sovereign, exchange risk, location risk. International risks like the war which is happening now, the interest rates which are rising. So, India is at present not increasing, but they will have to, over a period of time, the interest rates are rising, inflation, natural risk, and political. So these are various headwinds. But so now again, I'm coming back to a childhood game of ours, the Ludo. So whenever you invest into any of these, the equity or the sector, so what happens is you start investing, and one of these risks comes, and one of these, so you go back to your, the returns are again reduced. So it's very important that you take this, take these into consideration, and how you can. So it is very important that how you even mitigate these risks. How can you mitigate these risks?
Absolutely, which is where the risk parameterization, that the way you've explained it is very interesting. Ludo was the thing which was coming in my mind too. But look at the way it's come out. The asset classes to kind of a company risk, which is pretty local. Then it's national risk, and of course international risk can really be one can expose to an immense amount of risk out there. But amongst playing around with, while you are juggling between the sector allocations, then value and growth, and also taking care of the risk and all, it could be very, very extensive for any regular investor or regular company with cash. What do you think are the passive strategy to kind of, get the returns, do fine job, but still escape the volatility and other things? So is there something that you would like to share?
Yes. See, national and international risks are not under our control, but we can always take care of the company risk by investing in indices and through indices, ETFs, which is a better form. So let me come to ETFs. So exchange traded funds, what are they? They are a basket of securities that track the performance of an index, and such as Nifty, Sensex, and now there are sector ETFs also. There are gold ETFs, also commodity ETFs. There are debt ETFs like a GSEC ETF or a liquid ETF. So there are ETFs, exchange traded funds are available across assets. So let me explain to you that how does it work and how it is better. So in fact, it takes the positives of both the stock market and the mutual funds. Because when you invest into individual stocks, there are chances that the company inherent risk can create a problem and your returns can go negative. But when it is an index or a portfolio, then and it is diversified, it is, even if one company is not performed well, overall your index would perform well. And how it is better than mutual fund? Because it is live. For example, say like like the pandemic, the lockdown came and the markets were crashing. So if the announcement came and the market was crashing, at that point of time, say index was 12,000 or 15,000, whatever it is, you could sell your ETF at that point of time. So you would have just got it at a 1% low or something like that. But if you had sold a mutual fund index fund, you would have got only end of the day NAV, where the market would have gone down by 5-7% or 8%. So you are getting at a better, it's better than a mutual fund index fund, and there are many more advantages than just because it is diversified. It is so let me tell you the advantages is diversification amongst companies. When you take assets, it's diversification amongst asset classes. So no single asset or no single company underperformance can affect the returns. The cost is lower because when you are you're investing into one company, the cost is the same as buying one ETF. So, but here in one ETF, you get a basket. So you're investing into many companies and you have a live NAV tracking. So these are the advantages. And we have products for these two in our PMS.
Perfect. No, this is pretty helpful, Sucheta, because in fact, on a lighter note, you also said that which is a fact, of course, that the pharmaceutical sector has done very, very well. And of course, that it won't be surprising that most of the MSME or can utilize their extra working capital, or it's their own cash that is generated out of business income, and they are surplus, so they can look at investments. I believe Oswin mentioned that this is something that he is hearing from a lot of members, that some guidance on asset allocation as well. And once BillMart comes with the product of MSME to MSME funding, of course we'll come knocking to Oshwin again. But Sucheta, just to kind of wrap this up very well, that how does one get there? How does one get to the advice, and how regulations play in the whole PMS space? If you can just quickly throw light so that we can, yeah.
So you have to be a SEBI registered portfolio manager. And you have your products where you can, this is where I would like to give just give you a gist of what the products are available and what we can offer. But there are regulations like there's minimum of 50 lakh. And now the most important regulation which has come is that you cannot advise and execute. So that is because of, I mean, there are these Carvey problems, and there have been companies which have not been doing it the right way and using. So you have to have a custodian, which is outside you. You have to execute it outside your company and not your company. So things are much easier and much simpler and safer and more secure. So your investments are more secure because they don't stay with the company in a PMS. They stay with the custodian. The bank account is also with the client. So it stays, and this execution is also done outside. So that is one where we specialize is the research and the advisor and the portfolio manager. So we have one product where I can show you the dynamic ETF fund, where we, here we are doing maximum, to returns with minimized cost with a proper asset allocation. So we have equity where we have all these ETFs where we do only ETFs. We have NSE 50, Nifty, Junior, Mid Cap, commodity, debt, and we also have the flavor would be, see, these are standard returns, but the flavor would be when the research is on the sector. We invest into one or two sectors which we believe would do very well in the next 2 or 3 years. So which would actually give and enhance your returns, percentage returns. So, and we have these asset allocations from, how we do would from equity sectors, commodity, and debt. So there was a time when we really increased the debt and the gold or the commodity. So it all depends on how at that point of time, based on research. Of course, the research is, it's data of last how many ever years, maybe 10, 15, 20 years. Based on that, we take these decisions. So that is it. So other products which we have is Atlas Leaders, which is an open-ended dynamic equity scheme investing majorly across large cap stocks, and Pearls, which invests into high growth potential mid cap and small cap companies. So of course, this requires a lot of research where you need to talk to the management. This is much more detailed because the risk is also higher. So these are our products, and this would be it at any point of time. You need to contact us. These are our contact details. You can email us at pms@aifl.net. Our contact numbers are there. So this is where you want to know something more, you can always, let me know.
Lovely. Thank you, Sucheta. That was quite comprehensive, and thanks for all the required disclaimers as well. It is absolutely necessary to at least know things before you make a decision about things, whether it's a working capital or investments of your surpluses. So over to you, Kinjal, please take us through the rest.
Thank you. So now I would like to request Mr. Samir Limaye, if he can please, join us in sharing his special vote of thanks. Samir sir, all yours.
Thank you, Kinjal. Am I audible?
Yeah, perfectly.
Okay. Thank you. As an engineer, I've never attended a session which can simplify difficult terminologies. And thank you, Oswin. I think it was a wonderful opening remark. I do agree and completely understand what you said. Most of us in IPMMA or in IPME, most of us are engineers. Most of us have spent our lifetime either on the shop floor or doing the sales and marketing. When it comes to finance, accounts, surplus, managing the asset, managing the returns, I think we are far, far away. Making it simple, I think thanks to Sucheta and Jyoti as a part of my, not only the formal vote of thanks, but also I think the at a glance matrix which you shared puts most of the things in perspective and makes it so simple for all of us to understand. So thank you, Kinjal. Thank you, BillMart. Thank you, Jyoti, and thank you, Sucheta, for helping us to understand. And I'm sure if there are any questions, in case there are any more clarifications, with the help of IPMMA, secretariat, we can approach any one of you. Thank you, and over to you, Kinjal.
Thank you, sir. Thanks a lot. So now we come to the end of today's event. I see there are no Q&A. So, I mean, we'll still keep it on in the background for about 5-10 minutes if at all any questions comes. But yeah, so I would just like to thank each and every one of you for giving your time and making this event a memorable one. And we'll look forward to, I mean, hosting many more together and making it a grand success.
Kinjal, can I ask a question? Thanks, Kinjal. Can I ask a question here?
Yeah, sure. Sure.
I have a question each for Jyoti and Sucheta. Jyoti, first, you mentioned something about 86 days the bidding takes, just an example of 86 days bidding. Most of us are selling technical products which involve not only installation, commissioning, and thereafter validation of the equipment. So sometimes there is a delay in the invoicing getting processed because the product has to be satisfactorily be installed and approved by the end user. So in some cases, the invoice will get, I would say, not be paid for a certain period of time. It may overlap. So what happens in such a scenario? That you have mentioned 86 days as an example for your 11% bidding. What happens after that?
Yeah, thanks, Ashwin, for this question. Yes, 86 was an example. And the time and the product that we spoke about was bill discounting. But if we see even the regulations around it, a simple bill on an invoice should be settled by the buyers in a stipulated period of time, which is typically the 60 days, 45 to 60 days. But it's not followed in spirit, and regulations, policy makers, Government of India are aware of it. While the intent is for the right is there, but somehow there are gaps that still exist, both at the businesses or the buyer's end. So, so what do one do? How long can a bill be kept open? So typically the time horizon that the bills are there and which are expecting a closure in 6 months down the line, maximum for a bill discounting for an invoice, 6 months is a very long period anyway to have it open. But if bill, like if I'm a seller, I am putting my bill for discounting, you are the buyer, you say, okay, this is an authentic bill and my time required is 50 days. So, of course, we do not want a situation that it goes beyond 50 days, that one starts chasing, even if we are a marketplace, it's the financiers, which is where we have, in fact, which is where we are bringing, NASH mandates and other, checks and balances to deter any chances of spillovers. It is not good for the MSME who is walking the path of creating a track record, which can be utilized for the future. However, there is as I mentioned, it is not just a machine doing its job. There is a human intelligence. So there is a good intervention by the governance team here, and to preempt in case of any chances of some rollovers of interest and or non-payment of interest or non-settlement of that. So currently we do not have any such incidents. However, whenever it comes up, I'm sure the analysis which is done at the back end will preempt to have a conversation with the MSME on the other side.
Thanks, Jyoti. My question to Sucheta is, you spoke about PMS. Frankly, as I told you, as I mentioned in my address, that we are first generation which is afraid of going forward for digitization. The second generation is, yes, educated, but not very, as Mr. Samay also said, not very, Mr. Samir said that we are not very comfortable with digitization. Now the comfort level will come when we are assured of PMS that in no way it can be, there's no risk to it. So how do you make us confident on this part?
There's no asset where you invest and there is no risk. There's always some risk associated. However, that's what I said, you can reduce the risk by giving a good message. Yeah.
Sorry, not only risk as well as what are the transparency involved in this? Exactly.
That's what in PMS, that's what I'm saying, that you have the custodian in your stocks are with your investments are with the custodian. You have your own bank account. You can track it on a daily basis.
Daily.
What is your NAV? What is your performance? You just have to put your user ID password and you can track it. We do not have that control. It is with the, like say assume, so say HDFC Bank, the custodian is with them. So they take care of it. So when you buy, when we buy as a PMS, it goes to that custodian. And the bank, it's the amount also stays, whatever the money is there, stays in your bank account. So on a daily basis, there is complete transparency, which is as per SEBI, it is required now. So they say quarterly, but it's on a daily basis that you can check what is your NAV, what is your performance, you can check, or what if something new has been invested, you can check.
So what you're necessarily saying is, if I'm having a demat account with say HDFC or ICICI Bank, I continue with that demat account. And
no, with the PMS, you need to appoint a custodian.
Custodian, okay.
You need to appoint, but that is done with the PMS itself. So, but it is like a demat account, but there is a custodian who takes care of that.
Okay.
It's a similar thing, something similar. Yeah.
You have any special offerings for the IPMMA where, you know, if not 50 lakhs, maybe a kind of a reduced amount?
No, see, this is a guideline as per SEBI.
Per SEBI.
So SEBI registered somethings like an investment advisory. Okay. So that is, but then that we cannot execute for you. Say like here we have to give the execution outside. So you may have, there is something like an advisory which we can go for a smaller, but you execute at your end. So there are certain things like that. That's a different, but PMS, it is as per SEBI guidelines, it is minimum 50 lakhs.
Okay, thanks, Sucheta. One last question to Jyoti is, I don't know if you address the thing on loans, capital loans, asset loans. For what period and what tenure? I'm not sure if you have mentioned on that. Are you able to do that? Is BillMart able to do that?
Yeah, I didn't cover the working capital loan, which is typically for a longer time horizon. Correct. I concentrated on bill discounting, which is now an immediate, a very easy way to get digital experience, gets more savvier, and start the process. Working capital loan, of course, would see a little extended. As I said, the term horizon would be 6 months and upward and things like that, backed by real paperwork and the business case. Having said that, working capital loan is something that we are looking at introducing soon, but let's get the bill discounting and shorter duration sorted first.
Any fear of us, exposing our clients' information to you and the bill details to you? Any fear of that we may have, we should have?
Not really, because the world has moved from traditional screening and credit profiling of the firm, which was purely based on your cash muscles. If you have cash collateral or bank guarantees and things like that, it's moving to your data, your own track record. Like for an example, the GST, the details would have everything, entire parameterization, your history of payments, your cash flows, XYZ. So instead of filling up gamuts of documentation, if you just provide your GST details, that's good enough for a platform like us to carry the analysis and keep it ready for the financiers to look at you from the optics they evaluate, right? So each time you settle a bill, it is rightfully done both on principal as well as interest, XYZ. We capture it in our analytics. It gives you, in fact, now the tradition of rating online is going to be starting, right? Where if you have a track record on settling your payments on a digital platform, that itself will make you qualified for getting rated. So there is no threat because as per the data policies, the data will be localized for Indian users. So it's not getting exported anywhere. It's very much here. The data stack is helping you get more qualified bids for the future. So I think it's a win-win for everyone. Yeah.
From the buyer's perspective, how much these buyers are aware of this bill discounting? Because they are also a partner to it, I would say.
Yes, in fact, blue chip companies which have huge vendor base, and there are certain sectors that thrives on vendors and distribution network. Predominantly, most of them should be aware of it, because one way or the other, they are business vendors on platforms. PSUs are definitely aware of it. The large conglomerates like Tata's and the Reliance and the Ambanis and everybody at Adani's is aware, because they have large network. Hindustan Lever. So it just makes everything very efficient, because the moment a big business comes in, it brings its vendor. In fact, the whole piece gets digitized for once and for all.
Can they, for any reason, decide not to accept the bill discounting process? They can refuse?
It's a free will country, anybody, but the point is, since it's adding value to their vendors, it makes their own supply chain gets more efficient. Vendor finances made available is one way of keeping your distributors and vendors together, more interested in the world of competition. So I think that it's not a showstopper or a block anywhere. Businesses, as and when we reach out, of course, there are more businesses coming on board to do it.
From a seller perspective, do you think the interest amount that, if you do have you done some calculation where you feel is beneficial for the seller who takes this 11% bidding? I mean, if you do a calculation matrix, in the long term, does it come financially beneficial?
It's a very interesting question. Actually, in the long-term perspective, what really becomes beneficial is the timeliness of funds being raised and rightfully employed. I think that's where the biggest business opportunity, right? Rest becomes the business requirement, whether it's 11%, as I said in one of the scale slide, that there are financiers who wants to lend from 5% to X%. And there are buyers borrowers who are ready to pay even more. But they don't know that once they become, once they come at a par at certain level, which was the liberty of certain big corporates, they themselves can come up in that and compete in that space. All right. So it's all about the track record, how you build up your character as a firm, as a proprietor, XYZ, all collectively adds up to get you the best from the financiers, because financiers are evaluating you. We are creating those analytical stacks.
My last question, and thankful to you for answering all these questions. The last question is, which countries abroad are using this method? I mean, and how flourishing is this new? For us, it's completely new and something really innovating and something really great. But what is the scene abroad? Globally, is it being used?
Of course. So it's a very interesting question. So MSME is not just MSME of India, and when I said digitally creating a digital infrastructure for globally, because MSME like here are MSMEs there as well. Okay, cash crunch comes knocking once in a while to everybody. In India, we have a very dire situation. So globally, yes, there are various platforms which are there to integrate, but their own banking is highly efficient and far-reaching. In fact, they had neobanks and microfinancing banks much before us. Like Europe had, multiple neobanks there. So they're ahead in the curve. And I think the speed of digitization that India is witnessing, I don't think so for decades any continent or country has ever witnessed that. Too much into the spread and the reach, the speed is humongous. I think it's a catch up of several years. We know what's, we have to do. So globally exists, MSME exists. They already have great access of stuff. And India is currently following the full step. I'm sure that we'll move far ahead in the game of digital, inclusion. Because if just to add this, even if you see the UPI data, the millions of users that they're adding up every passing quarters or 2 quarters is a testimonial of how it's getting adopted. So we are only talking about India right now. There is a Bharat, which is totally untapped digitally and all. But the only thing that exists there is UPI in Bharat. Rest, everybody is selling to India, which is digitally more aware, metros, mini metros, smart cities and stuff. But we are looking at converging the whole India and Bharat play and getting it, hope BillMart ready.
That's nice.
Yeah. So
over to you, Kinjal.
Kinjal, over to you.
Yeah, thank you. So, Oswin, I mean, if I can say something on a lighter note, you said what is the risk of, IPMMA members coming on BillMart? The biggest risk would be that we'll make you lazy. We'll be doing your job. We'll be collecting your data, storing it digitally. We'll get the NBFCs and the financiers to bid for your invoices. So, I mean, we'll do your work on your behalf and make you lazy.
That's nice. That's nice to hear.
That's nice. Yeah. No, that's a very interesting thing to say. In fact, me and Kinjal was discussing, that what would be the way to kind of really conclude this amazing, webinar that we were planning to have, and today we had, was, he said, Jyoti, fundraising should be as easy as booking your Ola and Uber, okay, or ordering your food online,
Absolutely.
and if we are walking the talk, which we are, because fintech is our strength, we know the pain point, we are directed well, we have the right guidance and the network and support of associations. So, the platform is just getting ready. I think the Bharat is just getting ready for more inclusion.
Right.
And even more ready to invest.
Absolutely.
Funds coming.
Absolutely. Don't miss that, please. No, lovely. Sure. I think we have of course, overshot the runway, but Kinjal, please wrap it up fast. Otherwise, I will be bolted with the question. No, questions more than welcome, but yes, let's.
Yeah, we don't have any questions as of now, but like I said, if and when we have any, so we have given a credits for anyone to get back to us. So as and when there are any questions, feel free to contact us, and we'll be more than happy to help you with any of your doubts and queries.
Great.
So on that note, I would again, and for the last time, wish to thank each and every one of you for giving your precious time to this event and making it a grand success.
Thank you.
Thank you. Most
Thank you.
welcome.
Thank you.
Thank you, Ashwin, Samir,
Thank you. Thank you.
Sucheta, Kinjal.
Bye-bye. Yeah, see you.
Bye. Bye.
Thank you, everyone.